Hey y'all, wanted to continue my little series on top 10 questions I get asked or mortgage myths, whatever. And the number 2, I think I'm on number 2. Gosh, how can I not remember if I'm number 1 or 2 or 3 or whatever? Anyway, you do not have to put 20% down to buy a primary residence. Yes, there are some products you do. If it's a non-QM, DSCR, not DSCR, but bank statement, yes, you have to. But that's an old wives' tale. That's what our parents, our grandparents did, because they want to avoid PMI. Well, PMI is not the devil. A lot of times it's just a minuscule part of the payment. But if you wait to put 20% down to avoid PMI, which is private mortgage insurance, you're watching the equity go up and up, or not your equity, the house price is going up. So you know, hey, right now I only can put 10% down and the house price is worth $400,000. Well, it's going to take you another 2 years to put another 10% down. Well, now the house is worth $430,000. So what you're better off doing is going ahead and putting the 3.5, 5, 10, 15% down, whatever you can pull together. Get in there. PMI is not bad. And then what happens is you're watching that equity grow. In theory, you know, there could be a 2008, 2010, probably not. But you're watching that equity grow as you're making your mortgage payments, which you would be making your rent payments anyway. So if you hear nothing else today that I say, it is PMI is not the devil. You do not have to wait to 20%, put 20% down on a primary residence, and get in the game and start collecting those the equity check. So I hope you learned something today, and as always, I'd love to turn your mortgage into a work of art. Have a good day.